So let me go to financial market mania, section 4. Financial market mania is based on, first of all, what prices are affected. And it turns out it's the fixed income and the equity markets, not only here but abroad. At the bottom of page 5, it gives you some idea of the recovery that's taken place since early March. This is the high yield market, i.e. junk bonds, and this is prices, not yields, but from an index in March 2nd, the riskiest of the corporate debt in the public markets have recovered quite a bit, like about 40% of the value, but you have to realize how far they fell prior to that. And I doubt if they've recovered all the way, but I'm not sure about that. Ironically, the there's a high yield, this is high yield. This is junk. Yeah, this is junk. And this is the, not low quality, this is the high quality debt. The title's incorrect. Low yield? Okay, low yield is high quality. You don't go out as a salesman sell junk, you sell it as high yield. Long story short, what we have is a picture of the recovery, and the great irony of it is that from that date, and a lot of it had to do with the fact that the collapse that took place prior to that, the prices have gone down very far, and the recovery has been greater in junk debt than high-quality corporate debt. And it looks like about 20%, about 15-18% in the probably investment grade, and it looks like about 40% in the high-yield market. The high-yield market has virtually, it was at a yield spread 11 months ago at 22 over the Treasury. A yield spread of 22 over the Treasury. Last I checked, it was like 6 or 7. So the recovery has been absolutely enormous. So the question is, where did that recovery come from? And the recovery came from these people who believe in the C path. They believe that we're saved, number one. And because we've been saved in the past, at any time monetary and fiscal policy ramps up, it turns the economy around, and so those distressed situations won't end up unwinding. So that's part of the reason. There are other reasons, and a very important reason. One of which was just technical. The shorts were overwhelming, and once there was any movement upward, there was such a short covering rally that it gave a lot of boost to the market as well. But moreover, the most important reason is an article for which I gave you just one page of, and that is, I guess, page 2, which is the carry trade. What has unbelievably happened, and I say unbelievably because it was a year ago that the carry trade was getting slaughtered. The carry trade simply is financial investors, hedge funds or others, it could be you or I, you borrow at the bank rate plus some margin for the bank. Now we have a situation now where the interest rates across the world in every country are extraordinarily low for, I guess, high credit quality with collateral. So basically, the borrowing rate may be, 3, 4, something like that. The cost of money to a bank these days is, less than a quarter point from the Fed. They load that up 300 basis points, so that'd be 3 1/4. And then when we're in a situation when the high-yield debt prices were so crushed, it was not unusual to have 20% yields. So if you're borrowing at 3 and you're investing at 20, you live on the spread. Now, this is precisely and exactly what got us into trouble between 2002 and 2007. You're playing, you're levered, you're playing the game with someone else's money. Now, what causes them to do this is, number one, the size of the spread. Number two, they would generally, the carry trade folks would look for the country. Now, we're now into global financial systems, so they would look across the world for the cheapest source of money. And they also wanted to make sure that if they were borrowing, for example, it used to be Japan, that the Japanese exchange rate was stable because they were going to end up having to pay that loan off. And if the yen was appreciating, then it became more expensive to pay it off. So they'd always be looking for the for the funder of the carry trade to be the banks in a country with a very low interest rate and a stable exchange rate. Japan fit the bill for about 10 or 15 years. Now what's happening in the carry trade is if you want to invest in U.S. securities, you don't have to go to Japan and take exchange rate risk. You can borrow in dollars and repay in dollars because the borrowing rate is probably in the 3s, maybe 4. And that junk was available in the 20s. So the spreads are enormous. Now, what causes them to come out of the woodwork to do it again within 6 months of being slaughtered from the unwinding, the collapse? When you're carry trade, you're in leverage. You're buying in leverage, and when the asset price goes down, then your capital implodes with leverage. Leverage works both ways. So they just went through a meltdown, and here they are stepping up to the plate again 6 months later. And I can well understand carry traders doing this, but what I can't understand is the bank lenders doing this, who just went through the trauma of seeing their balance sheet implode and going through the humiliation of having to go to the government to get recapitalized. So, but it's back. The carry trade is back. A number of articles I found. This is the first one, and this I found, May 25th. That seemed to me to be one of the few logics which caused me to believe that both the stock market boom and the debt market boom had to be with levered money in some multiple of capital. And indeed, you find any number, just go on Google, put in carry trade, and any number of articles on the fact that it's back and why it's back. But the other thing that caused it to come back is, quote, the volatility in the market decline. Because what will kill a carry trade is that if you borrow money from a bank at 3 and you buy high yield debt, but high yield debt starts to fluctuate and go down, you get worried about it and you sell off. So it's the volatility they like. A decline of volatility gives them confidence that they're not going to get a false reading to collapse the carry trade with a lot of transaction costs and pay it off, and then a week later come back and buy back into it. So what causes the carry trade to take place is a cheap funding source, a currency value that's stable, and low volatility in the market. And all of those characteristics were met, and guess what? They did it again. And it looks like this time the source of the carry trade is not the yen, but the dollar. I've seen other articles to the effect that it's also possibly the UK, and probably the UK and Europe, I guess. But the other suggestion of why it's likely the funder of the carry trade is the U.S. banks is the dollar is declining in the foreign exchange markets. And if you are the funder of the carry trade, they come to you from all over the world, borrow the money, and then they take it to the emerging markets where they get even a larger spread. So the dollar sales take place and push the currency down when the carry trade is being wound up. And then when it becomes wound down and they pay it off, then the dollar goes back up. So one of the explanations also of the dollar going down is it's logical that we're part of the carry trade. So basically, then the C group who see the economy growing, they're also the ones who are participating in this market, not only because their expectation the economy will turn around, but they're getting financed royally from the banking systems here and everywhere to participate in the game. And it's not uncommon to see returns for those participants of 100% in the last 6 months. Now the market is beginning to wonder where we go from here. I mean, the easy money has been made, as they put it. So we've had a financial market mania. The financial market mania, which is 4, is based on the assumption of this recovery path and just simply based on history and the fact that so much cheap leverage has been made available to them. So there we are.